Hey, happy Friday. Hope you're doing well today. Welcome to the Fetta Effect. For those of you that don't know me, I'm Jerry. I own WealthX. So I want to tell you a little bit about WealthX, a little bit about me, and we're going to hit some awesome topics today. But WealthX is my company, and WealthX exists for one reason. Okay, we believe that everybody has the right to live a life by design. And the reason why is it's a shame for you to go your entire life and not see what you're capable of doing while you're here on earth, while you're alive, with your time, because you're trading time for money. Because you're trading time for money, you never get the opportunity. You're always working, you're always trying to get that paycheck, right? So what we do about that is we help people build passive income through assets that cash flow so that they can win their time back and actually live a life by design. That's the one reason my company exists, is to help you live life the way you want it to be. So I'm Jerry, I own the company, and basically what I do is every Friday I come to you with the Fetta Effect, and the Fetta Effect is about you as a person, you as a business, your personal economy, the big economy at large, all of those different things, but we're focusing on money and how to grow, how to expand. Okay, so if you're just tuning in, that's who I am. I apologize if you didn't know me already. Go ahead and share this if you're coming into it, but today we're going to talk about the financial documents that everybody should have. Okay, some call this a financial plan, some call this a net worth statement, some call it a budget. Those are all things that it's referenced as, but I want to go through specifically what is the actual document. What do they actually look like? Because it's really easy to just say, hey, you should have a financial plan. Super simple, right? But no one knows what that is, and I've talked about this before. So I want to break through and really identify and isolate what is a financial plan. What are the actual pages, the actual numbers that you need to have in order to win financially? Now, I want to just make a discrepancy here. I want to make sure that we segregate out a financial plan is not a historical statement. Okay? By definition, a plan is not something that happened yesterday. A plan is what are we going to do tomorrow? What are we going to do in the future? It's not where are we at currently, and it's not where have we been. That's not a financial plan. And we've talked about that. So I want to go into why you need to have these documents. So when I first started in the industry about 7 years ago, we had a tool called a financial needs analysis. And I worked at a life insurance company. So the financial needs analysis was a tool that we would put together for a client. And in all honesty, it was, giving them mathematical reasoning behind why they need to sell or why they need to buy life insurance from us. Hey, I love the likes. Hey, Steve, thanks for joining. If you guys need sales training, talk to us. Talk to Steve Spray. We're going to get you hooked up. Thank you all for watching. We're talking about what financial documents you need. Okay? And so you don't need to be looking at historical statements. You need to be looking at what is the future going to look like. Lexi remembers the F&A. It's like King of the Hill, right? F&A, Cotton, financial needs analysis. So we would look at a client's net worth. We would look at their expenses. We'd look at their debt. We'd look at all of this stuff. And then we would tell them, based on their finances, why they need to buy insurance from us. That was what we did at that company. Now, there was a degree of help to that. What I learned in that experience, this was 7 years ago, was that most people, they don't know what they're doing financially. They don't know how much comes in. They don't know how much they pay in taxes. Most people don't know how much they spend every month. And anytime knowledge is missing, it's typically because there's a lack of organization. There's confusion. Okay, so if you're watching your finances and you're confused on what my budget looks like, you're probably not going to do a budget. If you're confused on what are my assets, if you don't know what an asset is, you're probably not going to pay attention to them. If you're confused on what's a liability, you're probably not going to pay attention to them. So that's the first component of it. The second component, though, is if you're not winning in those areas, you're less likely to look at them. Okay? I remember, when I first began my business, the months where I knew I didn't make enough income, I didn't like looking at my income statement. I would ignore it. I would hide it. I would try not to confront it. I would try not to look at it because I knew the numbers weren't good. So there's a degree of just consciousness, knowing what you have, confronting, and the reality is if you don't understand it and you're not winning at it, you're less likely to do that. That's where I come in. That's where I come into your life. I'm going to put you in a position. You look at your finances, you confront them, you understand them, you're probably not winning at them, and we already know that before we look, and I'm going to put you on a plan so you can start winning. Okay, it doesn't mean that instantly they're going to get better, but it means that you're going to know where you're at. So here's some of the documents you need to have. Here they are. So if you're actually serious, I want you to write notes and make sure that you have these documents. And if you don't have them, direct message me or give me a call, 907-414-5337. You can also go to my website, wealthxpro.com. But the first document that you need to have is you need to have an income statement. Okay? And the neat thing is you already have one. Every month you get a pay stub from work. That's your income statement. Most people don't look at those. They come in either, digitally, and people don't look at them. They don't go online and check. And they also come in the mail, and every time I visit a client, it's an unopened envelope. They haven't looked at it. Why do you need to have an income statement? Financially, you can't exist if you don't have income. You need to know what your income is. You need to know what it was. You need to know what it is currently, and you need to be able to project where it's going to be. So you need to have an income statement. The second thing you need to have is you need to have a budget. Okay? Now, budget, I want to make sure I get this across. Budget is not a lifestyle. It is a financial statement. So when I say budget, all of those people that cringe at that word, I'm not giving you an action phrase and saying go buy $3 cereal instead of $5 cereal and hope you get rich. That's not what I mean. I'm objectively stating you need a statement of what did I spend? What did I put out? What did I inflow? What did I outflow? So if you don't know your outflow, then you're going to have no idea what your inflow needs to be. Okay, so your budget is going to be two components. It's going to be what do I plan to spend, which is always going to be wrong. Just pretend when you come up with those numbers that they're just probably not going to happen. You might be close, but you'll never get the exact dollar amount. So you need to go back and audit it. Once a week, you need to be going back and looking at, okay, what did I actually outflow? What did I put into groceries? What did I spend on gas? What did we spend on outings? And the reason is consciousness. It's not because you're going to get rich by budgeting. You will never get rich by budgeting. Nobody will. I promise you that. The only way you get rich is through income, expanding, okay? Earning income and multiplying income through assets. So the budget is going to give you a reality on where you're at. Sometimes we run our finances like we're a lot bigger than we are. And so our budget helps us remember, oh, dude, I only had a $200 margin at the end of the month. Okay, margin is your surplus. If you do your budget and you find out that you're only saving $200, then you're not going to make a $500 decision. Okay, so that's the second thing you need to have. The third one is a number of financial ratios. I'm going to pull up actually what we use with our clients because I want to show you guys specifically when we're coaching a client, what numbers are we focusing on specifically. Okay, so we go through and we do the income, we do the expenses, we do the budget, but we do those things so that we can come up with a series of benchmarks. Now, I'm going to tell you right off the bat, the benchmarks that I share are historical numbers for the top 1% of wealth in our country for the last 100 years. Okay, that's the benchmark. Okay, we're going to shoot all the way that high. Even if that's not your goal, if you're aiming at that, you're always going to make progress. Okay, so the point is not you have to be in the 1%. The point is success leaves clues. If we follow those clues, we're going to get similar results. Okay, if we ignore those clues out of spite, then we're not going to make progress. So here's the numbers. One of the ratios that we look at is savings rate. Okay, savings rate is the total amount of income in comparison to your gross income that goes into either savings or investments. Okay, the benchmark that we teach our clients is you need to save 40% of your gross income. 40% of your pre-tax income. Now, if you're watching this and 40% sounds like a big number, that means you don't earn enough income. Okay, I agree 40% is a huge number for anybody that makes less than $10,000 a month. If you make more than 10 grand, 40% means that you save 4, you live on 6, and you can live comfortably on 6. So with that 40% number, there's actually two tie-ins there. You need to save a ton, and you also need to earn a ton. Okay? We don't live in an economy where you can get by on $60,000 a year and hope that you're going to send your kids to college and be financially independent and make it. It's just not real anymore. It was 20 years ago, but the reality is wages have not increased with currency devaluation. So when you go to work and you work at your job and you make 5 grand, that 5 grand is not going to buy all of the things you needed to buy this year, let alone 20 years into the future. So you need to save 40%. If anybody is attempting to get to that number now, I want to see some likes. I personally am, so I'm going to throw some likes out. But if you're trying to get to that 40% number, whether you're there or not, throw some likes out. Now, the other thing we look at is your passive income ratio. So out of your gross income, how much of it is passive? Okay, you don't want to work your entire life trading time for money. Here's the deal. I'm going to break this time versus money thing down really quick. Money is literally a piece of paper. Literally, nothing backs it. In 1913, The IRS came into existence, the Federal Reserve banking system, which is a central banking system, came into existence, and ever since then, they have diluted the buying power of our currency. Okay? In the 1970s, we stopped using gold to back our US dollars. Why? So that we could send dollars overseas for goods that actually are of value, and essentially I can trade paper to get an iPhone, and the iPhone's actually of value, the dollar's not. Okay, that was our scam. That was what we did in the 70s. So ever since then, the dollar is backed on nothing but the full faith and credit of the US government. It's a debt instrument. It is not cash. It is cash, but it's not cash. You know what I mean? It's debt. It's backed by debt. So if you're trading time for money, over the last 100 years or so, the dollar has gone down in value by about 2,400% cumulatively. Okay, so that piece of paper that you spend 40 hours a week trying to get, it went down 2,400% over the last 100 years or so. Okay, your time though, your time goes up in value. You can't get back yesterday. Okay, so think of it like this. You just did yesterday, you have today, and you don't know if you get tomorrow. That makes time infinitely valuable. So when you trade something that is infinitely valuable for a piece of paper that's going to go down in value, you are doing yourself a disservice. So you have to have passive income. Jeremy Tompkins is on. Jeremy does real estate, investment real estate. I think he's got like between 6 and 10 units now. Jeremy understands passive income. Jeremy, post in the comments how many units you have. Jeremy understands passive income. So what we work on with our clients is at some point in time, you stop trading time for money. Now, there's no such thing as totally passive income. I do want to say that. When I say passive income, it's a game of degrees. Income can be more passive than other forms of income, but there's no such thing as, kick my feet up. Jeremy has 6 doors. There's no such thing as kick my feet up and just watch the checks flow in. Like, you're doing something. So there's no such thing as absolutely passive income. There's more and less. So we do passive income, and we teach people that your passive income should be ever increasing. So that's the first thing. The second thing is that at some point, your passive income should be almost 100% of your total. And I say almost because when you look at the net worth of the top 1% of wealth in our country's history, about 68% of their net worth assets is wrapped up in small business equity, which is a little more active. Okay, so you're always going to do something. You're always going to do something, but we don't want you slaving to trade time for dollars. Okay, so we want you to be able to pull back, but you still will have a purpose, and something about that purpose will generate income. So 100% of your income will never be passive. A large portion will be, but it should always increase. Housing expenses. You guys ready? Your housing expense should be less than 25% of your gross income. Okay? Housing expenses, your debt, your taxes, your insurance, that total cost should be less than 25% of your budget. What does that mean? You don't get to be house poor. We do not allow our clients to be house poor. House poor is this: when your house makes up the majority of what you consider to be your assets. Your house doesn't pay you, you pay it. That makes it a liability. Okay? It is not going to get you financially independent. So we don't want you house poor. What does that mean? It might mean that you get a lower end house. It might mean you rent, but you're focused on payment, not on ownership. Okay? The ownership that you have is your personal economy, and that's going to be there longer than your house will be. So do not sacrifice your personal economy to have 4 walls and a door. It makes no sense. Okay? The other thing that we're looking at here, now I'm going through these pretty fast line item, personal rate of return. Okay, you have a rate of return personally. If you are your own best investment, which you are, we should be measuring what your rate of return is. So what is your personal rate of return? The personal rate of return is going to be your total assets versus the passive income generated by those assets. Okay, so we look at this passive over actual assets, your personal rate of return. It needs to be based on real assets that produce cash flow. So this dives into another category. When I work with clients, I don't let them count their primary residence as an asset. We have a category called stuff. Stuff is for things like your house, your car, your personal stuff, things that you own that don't pay you an income. An asset, by definition, only is something that pays you an income. Okay, so when we're measuring your personal rate of return, it's what's the total value of your assets in ratio to the passive income being produced. Now, something about this number, it needs to be increasing by 3.15% per year minimum. Minimum. Why? Because that's what inflation is according to CPI. And CPI is not even an accurate description of inflation. If you go to Shadow Stats, they're projecting inflation in reality of buying power at about 12%. Okay, so somewhere between 3 and 12 is the truth, and you need your passive income out earning that devaluation of currency or inflation or whatever it is you want to call it. The reason why is you can't beat inflation just by hedging it, hoping that you have gold and silver and these other things. You have to actually earn income at a faster rate than the money can devalue. So if it's devaluing at 3% a year, you need to earn more than 3 so that you're winning and meeting that spread. Okay, it costs you 3% to own cash. Just think of it that way. If it costs you 3% to own cash, then the cash that you own should always make you more than 3% every year. And that's year over year. Now, what happens if you miss a year? If you miss a year, you just add it up. I was supposed to get 3.15 in my passive income increase. I didn't get that this year. So that means that next year it needs to be double. It needs to be 6.3. Okay, 6.30. And if I miss it again, it needs to be 9.45. So you have this basically snowballing, and the sooner you get the passive income, the smaller that snowball becomes. So here's the problem with this. For those of us and almost everybody that have been tricked into doing the deferred compensation, throw money in your 401k, give it to Wall Street, give it to strangers, let them manage it, pay the fees, your snowball is huge. It's giant because you don't have any passive income, and you never will. Okay? Your investments in that portfolio are not passive income. You're selling things. You're going to sell your mutual fund shares to earn income. That's not passive income. Passive income means you did not sell it. It produced its own yield. That's why we do real estate, because the income comes in regardless of the property value. Okay? So that's your personal rate of return, your tax rate. You need to know your effective tax rate. Not your bracket, your actual tax rate. I think Rachel Tolman might be on. She does taxes. She's an expert at it. You need to check her services out. But she will tell you, most people, when you talk to them, they say, I think I'm in a 25% bracket. They're not, though. If you do their effective tax rate, it's not actually literally 25% off the top. They pay a flat dollar amount, and then anything above a certain dollar amount, they pay a variable percentage in their tax rate. So when you take the flat and then the dollar amount of the variable and you average it out, then you can get the real actual effective tax rate. You need to know what that number is. Now, I also want to hit really quick, paying taxes is not a reason not to build wealth. So if you're watching this and you're saying, oh, I don't want to do the wealth thing because I'll pay a ton in taxes, it's ridiculous. Let's pretend you get taxed 40 cents on a dollar. That still means you made 60 more cents than you would have if you didn't get the dollar. So if you're in the worst possible tax bracket, like, you don't see Warren Buffett like, oh, I give up. Because he knows if he gets enough volume, that 60 cents adds up really fast, and it's more than he had before he got that 60 cents. So don't let taxation be the reason that you don't go build wealth. It should actually be a marker, an indicator that you're doing a good job. The more you pay in taxes, to a degree, probably means you're earning a lot of income, which is good. Okay? Now, there are different types of taxes based on how you earn the income. That's a conversation for another time. The other number you need to know is your debt to asset ratio. Notice I did not say debt to income ratio. I said your debt to asset ratio. Okay? What are your total assets? Assets are only things that produce income in relation to your debt. Okay? So that means that you're going to probably have a very high debt to asset ratio if you're not getting passive income producing investments, because your passive income producing investments, like a fourplex, the debt pays down. Your tenants pay your debt down. Now, if I just have a single family home and I'm throwing money at it every month, I'm trading time to pay my house off. That's not what we want. We want other people trading time to pay your house off. Your time is more valuable than a house. Okay? Your time is going to do more for you than your house will. It's just an emotional attachment that you have. So your debt to asset ratio, here's the one that kills most people, your primary asset to, or primary residence to asset ratio. So we look at all of your assets, excluding your primary residence. Assets are only things that produce income. And then we find out what percentage of your primary residence is it in ratio to your total assets. Most people, their primary residence is 200 to 300% of their total assets. Guys, this is a mistake. Your home is not an asset. It does not mean you don't need to own a home. If you want to, do it. You're not going to not do it just because I said, but do not think you're going to be okay just because you own a house. You won't be, okay? You're going to end up 60 with nothing in the bank, no investments, nothing going on, like probably 90% of America. You're basically going to be sentimental over the fact that you have your house paid off, but it's not going to do anything for you. So I'm telling you, if you're my age, if you're in your 20s or 30s, be really careful on this house thing. Okay, it does not mean you don't get a house, but it means if you do it based on your budget. You need 25% or less total expense, principal, interest, taxes, and insurance backed out. 25% or less, okay? Don't go get a giant house just because you qualify for VA or FHA. And if you do qualify for VA or FHA, you should be getting a fourplex, not a house, okay? I know I'm hitting the house thing hard today, but I'm very passionate about that. What's the other thing we measure? Income bracket. Income bracket. So we're looking at your income in ratio to the bottom threshold of the top 1% of income in the country. So to be in the top 1% of income in our country, and this is total income, passive, active, gross, right? It's about $37,000 a month. So we're measuring how close are you to being in that bracket. The reason why is because income matters. Okay, that's a conversation that we're emphasizing with our clients. Hey, how are you going to increase your income? You can ask all of my clients. I literally sat down with a client on Tuesday and I told him to sell his Xbox because he didn't have any extra income coming in that week. So we're like, dude, like you have a vacuum and you have an Xbox, you can sell those and that's the only income you have. The conversation about income matters. Okay, if you're not having that conversation, if your financial advisor is not having that conversation, then they don't understand wealth. It means that they don't understand the first thing you need to have to build wealth, income. It doesn't matter how. It doesn't matter that it's active or it's passive. It doesn't matter if it's sales or W-2 or government work. It has to be there, income. Okay, non-discriminatory, just objectively, you need to have income. If you don't have income, you're never going to build wealth. And the second thing is if you don't increase your income, you're never going to build wealth. Okay, the income conversation matters. It's the number one conversation. It's the most important conversation. How are you going to make more money this week? How are you going to make more money next year than you did this year? If you're in sales, how are you going to make this month better than last month? If you're not in sales, which everyone is in sales in my opinion, how are you going to make this next month better than last month? You have to have income. Now the next thing that we look at is income streams. The number of income streams that somebody has. So there's a stat that says the average millionaire has at least 7 income streams. So that's our target. If we get the income streams, we know that that's a leading activity and it's going to put you on projection to becoming a millionaire a lot sooner. Okay? The average person only has usually 2 to 3 when I talk to them. And so we start looking at, like, even if it's a tiny income stream, it counts. How do you get income? We count the PFD as an income stream. What does that mean though? The income came in, we put it on the budget, and it means that we didn't accidentally spend the tickets on Disney World and then pretend like we never got a PFD. We're accountable to it. So the income streams is huge. So those are the numbers. We're also hitting your assets. Your assets, I've already talked about today. I'm going to say one more time, things that produce income. If it does not pay you something every month, it's not an asset. If it goes up in value and does not produce income, it's not an asset. That's called hopium. Okay? You hope it's going to go up. You have no guarantee. There's no thing that you can control to push the asset up in value. And so we don't count that as an asset. That's icing on the cake. You need to know your liabilities, all of your debts, all of your debts. I'm going to say one more time, all of your debts. You need to line all of your debts out. So guys, these are the numbers you need to know. I'm going to hit a few more things and then wrap up today. If you have questions on any of this, go ahead and post them in the comments. I'd love to answer questions. I know that these are not things that most of us have, and they're not even things that most of us are taught to have. Okay, these are things that we have studied the wealthiest people in our country and said that this is the habit, this is the document, this is the number that the wealthiest people in our country have and have always utilized, and so we're teaching our clients to use those as well. I wish I learned this when I was like 14. I didn't learn this till I was probably 23. So I want to teach it to you now. You need to have a couple different things here. I'm going to scroll down. If you own investments, I'm just going to briefly touch on this. If you own investments, you need to have a full investment analysis done. Okay, and not one done by the guy that sold you the investment. Obviously he's going to give you one that looks good. He's not going to give you something that makes the investment he sold you look bad. That's just never going to happen. They will always show you something that makes their product look good. You need to go out and know how to look at your own investment and analyze it by yourself. So here's some numbers you need to know on your investments. A, how much money did I put in? Okay, here's a fact. If you own mutual funds, I want you to call them right now and ask them what your total principal contributions have been since day one. They can't tell you. The reason I know they can't tell you is because I have done this several times, and what they end up doing is they send you 10 years worth of statements and let you add all of your contributions up. Okay, so you gave them money and you said, you are responsible for my money, I expect a return. They can't even tell you what you gave them. They make you do that. Oh yeah, how much did you give me? And you have to go figure it out. So that's the first thing you need to know. How much did I put in? How much did I put in? Second thing, when I put that money in, was there a front end fee? How much was that? Okay, most people aren't aware. When you put money in the market, you typically pay a front end fee. What that means is 100% of your dollars didn't go to work. Now that's not a bad thing. Somebody had to get paid for doing a service for you, but you need to know what their rate was. You need to know how many dollars you paid this person to pick the right investments for you. Okay, so that's your thing, your total investments minus that front end fee. You also need to know what the annualized rate of return on your investment is. Okay, annualized, and the reason I stress that word, another word for it is compounding annual growth rate. It's the actual return. So if you look at your mutual fund statement, you look at your 401k statement, they're going to show you a return. They're going to say, hey, here's your average annual return. Here's the problem with that. Let's say you held the investment for 5 years, and over that 5 years, you made 10%. Okay? They're going to say, well, 10 divided by 5 years is 2, so you must have made 2% a year. That's your average annual return. Well, investing doesn't work that way. It's called compounding interest because the interest you earn compounds. So 2% that they calculated on the average annual does not include compounding. Now, I know this sounds like a bunch of nerd jargon, but I want you to understand why this is important. When they give you the 2% does not include compounding, which means that your actual return, including the compounding that really does happen, is less than 2%. So what's the moral of the story? You're getting a fake number. They are, on your statement, they are giving you a fake number that's higher than you actually got. So the number on your statement is here, it's higher. The number you actually made, if we calculate it, is lower than what you're being told, and nobody's disclosing that to you. So if you invested with me and I said, hey, you made 7%, and then you found out that really you only made 5, but I came up with a neat math trick to make it look like 7, you'd probably be pretty pissed at me, right? That actually is happening to you right now if you own those investments. If you own mutual funds, ETFs are a little more transparent because there's less that goes on with them, a lot simpler, but mostly it's the retail financial services mutual fund industry that does not report your return with a compounding annual growth rate. So you need to know the compounding annual growth rate of the investment, and you need to know the compounding annual growth rate of the index that fits into a similar category of the investment. The index is the average of all of those investments in the same category. Why? So you can compare and tell, is my investment better than the average? Okay, if it's not better than the average, why do I own it? If I wanted below average investments, I would go pick them myself. The reason I would pay someone is I want above average investments. Okay, so that's the other thing. You need to know your monthly cash flow when you retire. Also, you need to know your balance. So 2 things on the investing. When you retire, let's say you build up, I have a number here, $839,000 in your 401k. Okay, that sounds like a lot of money. Like if you got $839 today and someone told you to go spend it, you probably wouldn't be able to. In one day, you'd be looking for things to spend it on. But over 30 or 40 years, $839,000 runs out fast. So the problem with that $839,000 is you're going to start selling it over time to produce income. When you sell it, at some point it will be all gone and you won't have anything. So you need to know, what's my balance and will my investment balance last if I intend on selling these for income? The solution to that problem, I recommend just don't buy investments that you have to sell for income. Don't even do it. There's no point. Like, why would you buy an investment that you need to sell? If it was a good investment, logic says you would want to hang on to it, not sell it, right? So I hope you guys are tracking on this. The other thing you need to know is the monthly cash flow produced by the investment if you don't sell. Okay? With real estate, this is called your cash flow or your income, right? What is my cash flow, my net income on this property? With stocks, bonds, ETFs, mutual funds, it's called your dividend yield. Now, if you're doing dividend yield, just like if you're doing real estate, With real estate, you're taking your gross rent roll, which is all of the rent that everyone pays you before operating expenses, before property management, before debt, before insurance, before any of those things. And then you subtract all of those. It's just like a budget, your income minus your expense, and there's a number left over. That number is called your net cash flow before taxes. So just like that, with a mutual fund, when they tell you, oh yeah, it made a 3% dividend, that's your gross. Okay, just like with your real estate, that was before expenses. That's your gross. You don't actually get gross. You get it after expenses. So you need to take that 3% and you need to find out what's the dollar value of that 3%, and then what is the dollar value of the fees and expenses that I pay on my account. When you add those up, a lot of times you're paying about 1 to 1.25% per year on your account fees. So what does that mean? If you made 3 and you spent 1.25, you have 1.75 left over. Okay, so 1.75% of your total account value divided by 12 is the monthly income that portfolio will pay you if you don't start selling shares. Oftentimes it's a few $100s a month. It's not enough. Okay, so those are the things you need to know on your investments. I know this is getting a little bit laborious. I'm going to wrap it up right after this one because this is the most important. Guys, this is the most important. If you haven't listened to anything I've said so far, you need to hear this. You need to have an action plan. Okay? All of the stuff that we just talked about and looked at, that's historical data. Okay? It's a good index. It's good to know about, but it won't win your future for you. Having an action plan will. What is an action plan? An action plan is going to be your long-term life goals translated into dollars. So when I sit down with a client and we work on their action plan, I ask them, hey, what do you want to do when you don't have to worry about trading time for money anymore? Okay, what are you going to do with your time? You're going to do something. You're going to have 168 hours a week that you need to figure out something to do with, or you're going to get bored and die young. So you need to figure it out. When we figure that out, we determine how many dollars per month is required to get there. And I'm going to tell you guys this. I have not yet done a client plan over a 15-year time horizon where they didn't need at least $20,000 a month in today's income to live the lifestyle they really want to live. So this whole, when you retire, you can live on 60 to 80% of your income. That's BS. Why would you work 40 years so that you can restrict and live on less than you lived on the whole time you were struggling to get there? I want a big payoff. If I'm going to work 40 years, I want $20,000 a month. I want a giant number. I want it to be awesome. I want to be able to treat money like it's oxygen, which means I don't even think about it. It doesn't mean I'm Scrooge McDuck and I'm counting my coins. It means I have such an abundance that I can go do things and not consider the monetary repercussion of it. That includes good things, giving, helping people, taking people out to dinner, paying the bill, going on vacation with my family. Okay, all of those are things that I would like to do without thinking about how many dollars did I just spend. So that's your long-term goal, and then you need to dial them down. If you're 15 years out, you need to know, where is my 5-year target, where is my 1-year target, where is my 3-year target in the middle there, your 1 year, where's my 6-month target, and then in the next 30 days, what do I need to do to get there? If you don't come away from this with a what do I do today, what do I do this week, and what do I do this month, it's not a plan, it's a wish. Oh, this sounds pretty, and you throw it out there, but you don't actually have a tactical action step. Okay, that client I met with last week where I told him, dude, sell the Xbox, that was his 1-week plan. Like, in the next 7 days, you need to make income happen, and since you don't have any better options for me, you need to go sell this thing. So that's what you need to have to wrap it up. It's an action plan. The action plan is the actual plan. All of the other stuff I mentioned is not the plan. That's all history. It's historical data. It's not helping you get forward. You need to have something that helps you move forward to the next step. So guys, I know that was a ton of info. Honestly though, this is some of the most valuable information that you're ever going to hear on money because people don't talk about it. This is literally the financial tool that I put together for my clients, the formula that they follow so that they can build wealth the way they want to. So look up the words if you didn't understand them. Ask me questions if you didn't understand it. I want to thank you for watching. Go to my website, www.wealthxpro.com. Go to the individual and families link. And if you would like to sit down with me and put together a strategy like we just talked about, I don't charge for that. We can sit down and put one together today and get it knocked out for you so that you know your numbers. Okay? So again, that's www.wealthxpro.com. Families and individuals is the link that you'll click once you get there. Thank you for watching. Please share this. I appreciate you guys. I'll see you next Friday on the Fetta Effect. Have a great weekend.